Good evening, and thank you for your time. Asia is going through a period of unprecedented economic and political change. We think this will deliver very high GDP growth for the next decade, driven by the rise of the middle class, urbanization, and rapid technological change. We are looking for the best, fastest growing companies in one of the fastest regions in the world. We're calling this growth squared. Today, I would like to talk to you about our philosophy and our process. We'll go through some of the recent changes to the portfolio and our new ideas. And lastly, we'll leave you with a summary of our portfolio. So firstly, our fundamental belief that earnings do lead share prices over the very long run. This chart shows the 5-year total returns for shares by earnings quintile over the last 20 years. So your first quintile, this is the fastest growing companies in the whole of the universe. And what you find out is the fastest growing earning growth companies over the last 5 years do deliver the highest price growth, and the lowest deliver the lowest price growth. So share prices and earnings are highly correlated over the long run. And this is very, very similar to our investment strategy. We're looking for this top quintile of companies, those companies which can deliver 20% plus earnings growth for the next 3, 5, 10 years or longer. And we hope that by holding these companies through ups and downs of short-term market volatility, we can deliver long-term outsized returns to our investors. So there's a number of sort of buckets that we look for growth within the Asia ex-Japan region. And we think when we look at these ideas over a longer run, it gives that extra edge, the alpha. So our first bucket, pace of growth. We're looking for companies which can deliver a faster pace or rate of growth over 3 to 5 years than the market expects. And what we find is most analysts tend to bunch. They bunch their earnings numbers between 5 and 20%. They don't like to be too aggressive because you don't want to be too positive about things in the future because it's uncertain. We like taking that risk. We embrace uncertainty. Most of the market doesn't like risk. We like it because we believe by thinking about the future, by finding the best companies and investing in them in the long run, we can gain higher earnings growth, and via higher earnings growth, higher share prices. Duration. Certain companies which have great management teams, fantastic business models, the earnings growth does continue year after year, much longer than people expect. Again, taking that time to think about the longer term period, holding these companies for 3, 5, 10 years can lead to outsized returns. And lastly, this is the sort of surprise bucket. This is our special bucket. Asia ex-Japan, as you're probably well aware, it's a highly volatile and cyclical market in what can be a highly volatile region in the world. Growth comes and growth goes. So we have a special area where we're looking for latent growth, where people have got bored, they don't see growth today, but we see growth tomorrow. And these investments can too provide outsized returns for the patient investor. So let me give you a stock example. So Kingdee is a Chinese software company. They do enterprise resource software, effectively ERP, which does for SME, small companies in China, manages their financials all on a computer. When we first invested in this company, they sent out computer disks to their clients. So if salesman, computer disk, you bought it, you loaded the software. A company might use it for their small employers, they might not, they might forget. It was a fragmented market, not particularly very profitable or exciting. So what got us interested? Well, they started moving their software to the cloud, online. And our thinking was, this changes everything. Because once you're online, you're keeping your customer all the time. Software can be updated continuously. But most importantly, it dramatically alters what we call the TAM, the total addressable market, because so many businesses who are uninterested in using a floppy disk are happy to go online with a much better service. So we're thinking the overall market's probably going to be 3 or 5-fold where it was today. But also within that, the competitive dynamics change. And I think this is very important when understanding technology companies. Fragmented market offline, online, these markets are characterized by increasing returns to scale. And that basically means it's a winner-takes-all market. So the leading company is going to have 60, 70% market share versus King D in the old days, 15%. Wow. That also means the margins are not going to be 10%, they're going to be 30%. But we've got to get there first. So we took an initial position believing that the TAM was massive. We liked the management team. They had the vision. They wanted to do this. They were the first mover into the space. And the company had the financial balance sheet. Now, Asia being Asia, investing in this cloud business led to losses. And clearly, the market, it doesn't like losses because it creates uncertainty. So it allowed us to top up a couple of years later. More recently, as the cloud business is growing 100%, 150% in the last couple of years, the market has reassessed. Well, actually, maybe this is a growth company. Maybe this is exciting. However, the sideways movement in the last year or so, it's back to losses again. Growth is so good that the short-term losses are accelerating. We're having to look through that because today it is about 50% of the market online. It becomes a long-term winner. So we believe it's only a matter of time before we see margins go up to the 20, 30% level. Again, thinking long-term, think about the addressable market, think about the quality of the management, and ignoring short-term volatility so make great investments. So what have we been doing? I'll take you to 2 points. So firstly, we've been liking technology for many, many years. And 12 months ago, half of our fund was in technology stocks. We've actually been paring that back a bit and finding some other investments to go into, more traditional non-tech sectors, ASEAN, Vietnam, and commodities and energy. But firstly, I'll just take you through technology. You might have been aware that this shows the share of online advertising revenue in China since 2012, and the names of companies at the bottom. This big purple one, this is Baidu. They run the largest search engine in China, 80% plus market share, a bit like Google. Something very strange started happening in 2014. Their market share of the online advertising market started to come down dramatically. There were new players on the block. Tencent, Alibaba, a few others. Wow, that hasn't really happened in the US. What's driving this? Competition. The moat is not quite as big as we once thought for these dominant tech companies. Change is happening very rapidly. So you might be a great company today, but 5, 10 years down the line, competition does come. Tencent, we've been holding, this is the largest social media company and gaming company in China. We've had a holding for almost a decade. And during that time, the stock's compounded more than 20% per annum, maybe even 25% per annum. We've been paring back our position. Why? Because something that's very strange has happened again. I'll throw out a name to you, ByteDance. Probably no one's heard of it. TikTok. Again, probably not. TikTok has 1 billion users globally and a good 500 million outside of China. It's a social media app which over the last 3.5 years has gone from nowhere to 1 billion users. For us in China, the most important part is this is the share of social media and advertising. Back in 2012, Tencent was 80%. It was dominant. And we actually thought it was going to remain dominant. On our estimates, by 2020, their market share falls to 50%. And ByteDance, which is an AI-driven platform, which basically means they use big data and algorithms to directly give you the best news, or the news you think you want to see, whether you want to see it or not, very, very rapidly. And its uptake has been very dramatic by millennials and younger generations. So we think this is changing the dynamics of the ad market in China, reducing the growth rate of some of the tech companies on a 3 to 5 year view. So we've been taking some money off the table and finding other investments. First picture, a BMW. Brilliance China Automotive owns part of a JV in China for BMW. A few years ago, there was a chat show, one of these dating shows, where the suitor was asked a question, what car do you drive? And one of them replied, well, I don't have a car, I only have a bicycle. And the girl who was sort of asking the questions smiled and said, well, I would rather cry in a BMW than smile on a bicycle. And that basically became a meme for the Chinese young wish for affluence and growth. If you don't have a car, if you don't have a house, you can't get a wife. More recently, the Chinese market's had its first annual contraction in car sales for over 20 years. And BMW has suffered it as well. We think this is a very temporary phenomenon, and actually the market's going to go back to growth probably in the next 12 to 18 months. More importantly for us, the overall car market in China, which is 23 million roughly today, largest in the world, probably heads towards 30 over the next decade, giving ample growth for a company like BMW, but we can now buy it at a very cheap valuation because everyone's worried about near-term earnings growth and cyclicality. On the other side, this very fancy pair of trainers, the world's changing. The younger generation in China want to express themselves individually. Now, they can't really do that by freedom of speech, because that's kind of constrained. So doing it by having different types of sportswear. Li-Ning is the largest domestic sportswear brand in China. After Nike, after Adidas, there's Li-Ning. And a few years ago, we thought, well, this is a brand which has strong recognition, but very poor sales. Management came in and completely revamped the company, changed its distribution, but most importantly, changed its brand image from one of a Me Too copycat to actually streetwear, something which people are now calling a sort of the hypebeast fashion, where people just like airdrops. So they go to a shop where 500 shoes are dropped, and they're Nike shoes. Li-Ning's doing the same thing in China, and that's driven a company which had no earnings growth by analysts to delivering 30 to 40% earnings growth over the last 2 years and for the next few years. Vietnam. This is our largest single overweight in the fund. I'll just give you a few. Huge population, 90 million young, educated people. Low income. Government's opening up the country. We see Vietnam about 10 to 15 years behind China. But the single most important takeaway for us, and probably for you, is that every single country in the world which has gone from developing to developed has had one thing in common. They've grown their overall exports by more than 6% per annum for that growth rate, whether that's 20 years or 50 years. This is the export growth chart for Vietnam compared with the EU average. Despite the emerging market average going pretty much nowhere for the last decade, Vietnam's compounded at double digits. We think that Vietnam as a country is a structural overweight for our portfolios and probably should be for yours. And lastly, I'll just go for two slightly different areas that we're thinking about. Commodities. Well, not classic thing you'd think in a growth fund today. Well, Baillie, Indonesia is one of the leading producers of high-grade nickel in Indonesia. 3% of the world's production of nickel every year goes into batteries. by 2030, assuming only a 30% penetration of electric vehicles, that number becomes 100%. So everything goes into nickel. Well, what's remaining for steel and all the other uses? Mine production has to go up very rapidly. We think the tipping point is 2022 to 2023, when an EV becomes absolutely cheaper than an ICE engine. There's also the point where the battery technology changes to go from 40% nickel content to 90% nickel content. Now, that's good for the nickel price. It's also good for you because nickel enables the car to drive much further, so you get better distance from your car. So again, this is coming into that surprise bucket. No earnings today, but we can be very, very highly certain that they get volume growth and price growth on a 3 to 5 year basis to drive rapid earnings growth. And Jadestone, this is a very small oil and gas company. Our interest comes from a number of areas that effectively the Asian majors, state-owned companies, haven't been managing their assets too well. And given a low oil price environment and sort of mounting environmental pressure and groups to sort of divest of assets, we think nimble operators who can take existing assets, cut up costs, and run them much better can provide a very interesting growth story in what looks like a kind of ex-growth sector. So I'll just leave you with our relative sector positions. Still overweight technology, energy, consumer, healthcare, a bit of biotech over there. Underweight real estate, staples, utilities, financials, where we just don't see a lot of growth at the moment. And in terms of countries, 11% of the fund in Vietnam. Our biggest underweight, it has and remains Hong Kong, with the other countries in China and India being a key part of the portfolio. But kind of most importantly, and we'd like to carry on stating this, our forecast earnings growth. So our earnings growth is roughly double that in the market. These are not our numbers, these are broker numbers. Our return on equity, which is a measure of the profitability of the company, much higher. We're happy to pay up for this, 16 times earnings for a portfolio. But if you think about the higher earnings growth, if that continues over 3 to 5 years, then in 5 years' time, the PE multiple of our portfolio will be significantly below the PE multiple of the index, and we should have driven outside alpha and growth to you as investors. To which I will leave it there by finishing. We believe that investing in one of the fastest growth regions in the world does require thinking and buying some of the best growth companies. And that's why we say growth squared. Thank you.